You have this workbench in your portfolio, the last 10%
Yeah.
of so many small positions. And you mentioned this idea of, 100 baggers.
Right.
So I was just curious, what are some 100 baggers that you see around that,
Well,
you can share with us?
I've only had two in my life, and I still own those two.
Okay.
And that's Berkshire Hathaway and American Tower.
Right.
And the fact of the matter is, you only really need one. And and that's a really important issue as it relates to investing, is you really only need to have one great success. And that is as it relates to whatever your goals might be. And so the quest is, for me, the search is trying to figure out what the characteristics of those are. So if you think about my comments in three-legged stool and high return businesses and so on, our view is that most of the time you can buy these exceptional businesses at reasonable valuations. Mm-hmm. So in today's market, you can buy American Tower, you can buy Moody's, or you can buy MasterCard at probably something like 19 times next year's free cash flow, 2018. And that means an earnings yield of 5 or 5.1%. If we're still in a 1.5% interest rate environment, that's an attractive deal. If the business does in fact compound the free cash flow or book value or whatever is appropriate for that company in the mid-teens, and you pay in the upper teens for it, we like to say you'll get to heaven. and you'll do so without much risk. Periodically, the market gives us an opportunity to buy one of these great businesses at a discount. And then even more rarely, it'll give us the opportunity to buy one of these at a steal. So Berkshire Hathaway, I started buying back in the late 70s. And in the late 70s, my initial purchases were at $105 a share. And that's the stock today, is at $250,000 a share. American Tower is, to me, a business that is situated like Microsoft was. Microsoft was at the intersection of the growth of the personal computer. They had the operating system. If you wanted a personal computer, it ended up basically going through that toll booth of Microsoft. And so it was a fabulously profitable business. The growth of the wireless communication business, which as we know started with 1G and 2G and 3G and 4G, now they're talking about 5G. Each of those Gs requires a denser network of towers, more sophisticated antennas and so on, and the place they put those are on the antennas by and large. So that the tower business is a nearly identical kind of position that Microsoft was. Once they put that asset in place and they get above break even, the marginal return is, in the 90% range, north of 90%. And what American Tower has done is they now are in 15 countries. And when we started with them in 1999, they were in the United States, Mexico, and Brazil. Now they're in a total of 15 countries, including the United States. In all of the things that were telephony related in the late 90s were the hottest things since the 4th of July firecrackers. And 2000 came, and all of those businesses fell off the cliff because they were levered. Well, American Tower was levered 16-1. I mean, it's unbelievable. They're huge cash flow businesses and so on. And they had to de-lever that company, selling assets on a distressed basis in a declining market. And in the beginning of 2002, the stock was $5. It had gotten as high as in the 60s in 99. Beginning of 2002 was $5. We bought a position at $5, and we were really proud of it. In September, it was $2. We got on the plane and went to see the CEO in Boston, Steve Dodge, who was the founder. And what the market was focused on was that they had about $6 billion of debt, but they had $200 million that came due in November of 2003, 15 months hence. And it was payable in cash or shares at the option of the company. They were desperately trying to raise cash. They couldn't use their bank lines to pay that off. You can't use the bank line to pay off somebody else's capital. And so the lower the price went, the more dilution an existing shareholder was going to have if they used shares instead of cash. And in October, the stock got to an intraday low of 60 cents. We bought several million shares at about 80 cents. I still own mine. We have many of our clients still own theirs. That's the other example of a north of 100 bagger. What was interesting was that the business itself was a terrific business masked by a bad balance sheet. And you had great people working hard to get it straightened out, to preserve their own investment, their own foundations and that sort of stuff. So I think to myself, well, did I make a mistake by not really putting a lot of money to work? I was very timid. You know, if I say we bought a few million shares at 80 cents, that's not a lot of money. And so if I'd been more confident, I would have put a lot of money in there, and you know, I'd be fighting with Warren Buffett for the place on that list. You know? But you get the idea. So the point is that periodically you get a chance to buy one of these great businesses at a bargain, and even in a rare opportunity at just a steal. So